So, in April 2025, there was this economic policy that triggered a panic on Wall Street that, mathematically speaking anyway, actually exceeded the terror of September 11th.
Yeah, which is just a wild statistic to even wrap your head around.
Right. And then, less than a year later, a military decision permanently altered the price of global energy.
It was essentially a double shock to the system.
Exactly. So today, we're looking at a deeply controversial stack of data that asks a pretty terrifying question. Is the stock market currently pricing in the end of the American empire?
It is a phenomenal question. I mean, the data we are examining today attempts to answer it by measuring the exact financial tremors that happen when a superpower stumbles.
Right.
We're looking at the sweeping empirical analysis titled When Empires Fall, and it's compiled by a group of self-identified conservative financial and geopolitical analysts.
Welcome to the deep dive, everyone. Now, before we really dive into this data, I need to make a crystal clear, unambiguous statement to you, the listener.
Yes, this is absolutely crucial context.
The sources we're unpacking today contain some highly politically charged content regarding recent U.S. administrations. Specifically, they're looking at the second Trump administration. We want to be absolutely clear here, we are not taking any political sides.
None at all.
We're not endorsing or validating the viewpoints of these authors either. Our job today is strictly to unpack the fascinating data they've compiled. We are just going to report their arguments impartially and explore the historical connections the text makes to global market reactions.
Yeah, that context is vital, especially because the authors themselves make a really specific point of highlighting their conservative credentials.
Right. They own it right up front.
Exactly. They argue that because they've spent their careers being highly critical of the political left, their willingness to be brutally honest about massive failures on their own side of the aisle is actually what makes their data-driven analysis credible.
So they're trying to strip away the partisan spin, basically.
Right. They just want to look at the raw numbers.
Okay, let's unpack this. What is the core thesis they are actually bringing to the table here?
Well, the foundational claim is profound, and the authors, they do not mince words at all. They argue that the March 2026 military failure in Iran under the Trump administration is not just a tactical setback.
Which is how it's often framed.
Right. But according to their metrics, it is the greatest strategic defeat and the most profound humiliation in the entire 2.5-century history of the United States.
Wow.
Yeah. And they're using market data to prove that the global financial system completely agrees with them.
I mean, that is a staggering claim. Because we are talking about a history that includes, the burning of Washington in the War of 1812.
The evacuation of Saigon.
Right, the chaotic withdrawal from Afghanistan. So to understand how the market reacted to this, we can't just look at a single day on the calendar, right?
No, you really have to look at the sequence of events because the authors frame this as a sort of double shock.
Okay, so to understand the market's violent reaction to that Iran defeat in 2026, we have to look at the environment the market was already operating in.
Exactly. The first major shock to the system happened earlier, in April 2025.
Right. The text refers to these as the Liberation Day tariffs.
Yeah.
And these were sweeping, unilateral tariffs imposed by the administration. And what's interesting in the reading is that economists warned against them, international allies opposed them, but they were pushed through anyway.
And the immediate market reaction was just brutal.
The S&P 500 suffered an 11.5% peak drawdown almost instantly.
Right.
But why? I mean, tariffs happen all the time. Why did the market puke 11.5% over this?
Well, it really comes down to the mechanics of modern supply chains. Global trade isn't just about, moving boxes on ships anymore.
Right. It's way more complex.
It's a highly optimized mathematical equation. Multinational corporations spend decades optimizing their supply chains down to the fraction of a cent.
Wow. Just to squeeze out any inefficiency.
Exactly. So when a superpower imposes unilateral massive tariffs overnight, it shatters that underlying math completely.
So the companies suddenly have no idea what their margins are.
Or if their business models are even viable anymore. And that level of uncertainty forces institutional investors to just pull their capital out of the market to limit risk.
Okay, so an 11.5% drop is essentially the market screaming that the rules of global commerce have just been broken.
Yes. That alone is one of the worst policy-induced market crashes in modern history.
But it set this incredibly fragile stage for the second, vastly more destructive shock just 11 months later, the March 2026 Iran defeat.
Right. And the analysis meticulously details this event, The U.S. and Israel launched a combined military attack on Iran.
Specifically targeting its nuclear program and regional proxy networks, right?
Exactly.
And according to the historical and military data compiled in the report, the operation basically failed on virtually every front.
It was a total failure. The technological superiority just didn't translate to ground success at all. The strategic objectives were entirely unmet.
And the administration was forced into a ceasefire. But it's the actual terms of that ceasefire that the authors highlight as the real catastrophe here.
Yeah, when you look at the mechanisms of this ceasefire, the level of strategic surrender is staggering. First, the existing Iranian nuclear infrastructure remained completely untouched.
Which was the whole point of the attack in the first place.
Right, but it gets worse. As part of the cessation of hostilities, Iran was essentially granted the internationally recognized right to develop a nuclear weapons program.
Unbelievable. And then there's the economic chokehold they mentioned. Strategically, the ceasefire granted Iran de facto control of the Strait of Hormuz.
Which is arguably the single most critical maritime choke point on the planet.
Yeah, roughly 20% of all the world's oil flows through that narrow strip of water.
And the analysis points out that Iran immediately capitalized on this. They started levying a toll of $2 million per vessel transiting the strait.
$2 million
Yeah.
per ship.
Yeah. What's fascinating here is the sheer scale of the reversal. The authors explicitly lay out the before and after for us.
Okay.
Before America initiated this military action, Iran did not control the Strait of Hormuz, and they were internationally sanctioned against having a nuclear weapons program.
Right.
After the administration attacked and failed, Iran secured both.
Wow. So the authors refer to this as a total irreversible strategic capitulation.
Yes.
They make the case that the administration intentionally started a conflict,
Yeah.
lost decisively, and literally handed a hostile power the keys to global energy infrastructure.
And this is exactly why they rank it as a historically unprecedented humiliation, far worse than something like the fall of Saigon.
I see.
Well, when Saigon fell, America lost a regional client state in Southeast Asia. It was tragic, absolutely, but it didn't threaten the foundational pillars of the U.S. economy.
Right. Didn't break the global system.
Exactly. In 2026, America essentially surrendered its role as the guarantor of global sea lanes and handed nuclear capabilities to a direct adversary.
You know, it makes me think of an autoimmune disease.
Oh, how so?
Well, a standard policy failure or an external economic shock that's like a virus, right? The market has antibodies for that. You can price in the damage, fight it off, recover.
Sure.
But deliberately surrendering control of the world's primary energy choke point while simultaneously breaking global trade with tariffs. That is the body attacking its own nervous system.
That's a great analogy.
The market has no historical antibody for the United States intentionally degrading its own global hegemony.
That is a brilliant way to frame it, and it explains why the authors immediately pivot from, geopolitical theory to hard, undeniable financial data.
Right, they want to show the receipts.
Exactly. They want to show exactly how the market's immune system reacted to this self-inflicted damage. So they start with a deep dive into the S&P 500.
Specifically looking at the performance across different presidential terms, which I found fascinating.
Yes, the quantitative modeling here is really striking. They looked at the first 14 months, which is roughly 295 trading days of every single presidential term since Dwight D. Eisenhower.
Okay, so where does the Trump II administration sit in that historical ranking?
Well, if you look strictly at raw growth, the current administration shows a 9.3% cumulative return over that period.
Okay, so to a casual observer, positive 9% doesn't sound like a disaster at all.
No, it sounds fine. But the authors emphasize a much more critical metric for measuring systemic stability, which is maximum drawdown.
Right. And for you listening, maximum drawdown is the biggest single drop from a peak to a trough during that specific period.
Yeah.
It essentially measures the pain threshold investors had to endure.
Exactly. And during this 14-month window, the maximum drawdown was a massive negative 16.9%.
Wow.
Out of every presidential term since Eisenhower, that ranks as the 6th worst in modern history.
And to put that into perspective, the authors deliberately contrast this with the exact same 14-month window of the prior administration under Biden.
Right.
During that period, the market saw a 17.4% cumulative return, so nearly double the raw growth. But the defining metric is that the maximum drawdown was only negative 2.2%.
It is an almost 8-fold difference in peak to trough market contraction.
That's huge. And the analysis stresses that this massive gap a 2.2% drop versus a 16.9% drop, it has nothing to do with partisan cheerleading.
Not at all.
It is the literal mathematical market price of chaos versus stability. Markets abhor unpredictability. They price incompetence.
But the authors don't stop at just the S&P 500. They dive into the derivatives market to capture the raw, unfiltered fear of institutional investors. They analyze the VIX.
The fear gauge.
Right, the CBOE Volatility Index. Mechanically, the VIX measures the implied volatility of S&P 500 index options.
So in plain English.
It tracks how much of a premium investors are willing to pay for insurance against a sudden market crash. The higher the VIX, the more panic is pulsating through the algorithmic trading desks.
Okay, got it.
And the authors map the VIX against every major American defeat or crisis since 1990.
The numbers in this section actually made me stop reading and double-check the math.
Yeah, they're intense.
During that April 2025 tariff shock, the VIX spiked to 52.3. And the authors provide historical context for that number by comparing it to the days immediately following the September 11th terrorist attacks.
Which, remains one of the most psychologically and economically destabilizing exogenous shocks in modern American history.
Right. But wait, after 9/11, the VIX peaked at 43.7. I think to push back on this a little bit because it feels almost impossible to believe.
How so?
Well, September 11th resulted in the actual physical shutdown of the New York Stock Exchange for days.
Yeah, it did.
How can a self-inflicted trade policy generate a higher mathematical measurement of fear than the worst terrorist attack in U.S. history?
It is a totally valid question, and it really speaks to the difference between an exogenous shock and an endogenous failure.
Okay, break that down.
Well, 9/11 was a horrific external attack, an exogenous shock. But the market fundamentally understood that the underlying architecture of the American economy, the legal system, the consumer base, the technological edge, all of that was still intact.
The government was functioning.
Exactly. Tariffs, on the other hand, are an endogenous shock. They are the government intentionally destroying the rules of the game from the inside.
I see.
Institutional trading is heavily algorithmic, right? When the government proves it is willing to act erratically and attack global trade norms, algorithms simply cannot model the future.
Because the math is broken.
Right. That complete inability to price risk is what drove the VIX to 52.3. The market wasn't just reacting to a bad policy. It was reacting to the sudden realization that the pilots flying the economic plane were actively fighting the navigation systems.
Wow. That makes a lot of sense. The uncertainty of incompetence is harder to price than the certainty of an external tragedy.
Exactly.
And that brings us to how the market priced the Iran defeat. While the tariffs caused a massive spike in panic, the failure in the Middle East caused a fundamental structural repricing of the global economy.
Yeah, and the authors pivot to oil prices to illustrate this mechanism.
Right, because we mentioned earlier that the ceasefire gave Iran de facto control of the Strait of Hormuz and allowed them to charge a $2 million transit toll.
And around the time the market fully digested those terms, WTI West Texas Intermediate crude oil surged 14.4%.
It jumped from roughly $61 a barrel to over $70 in a matter of days.
Yeah.
But the authors highlight that this isn't just a temporary supply disruption.
No, exactly. This wasn't a refinery going offline or a temporary embargo. The mechanisms of global maritime trade were fundamentally altered.
Because of the tolls.
Because of the insurance cascades. Think about it. If a very large crude carrier is carrying 2 million barrels of oil, a $2 million toll essentially adds $1 to the cost of every single barrel.
Okay.
But the real cost is maritime insurance. With a hostile, nuclear-capable Iran officially controlling that choke point, the insurance premiums for those tankers just skyrocket.
Oh, wow.
And that cost is immediately passed down the supply chain to every gas station, every manufacturing plant, and every logistics company on Earth.
Right. When a superpower surrenders a vital global artery, it permanently changes the baseline inflation of global energy.
Yes.
The authors are proving that financial markets are brutally objective. The S&P 500 doesn't cast a ballot. Oil futures contracts don't care about campaign rally rhetoric.
Nope, they simply absorb the geopolitical reality and reprice the world accordingly.
Which leads the authors to a much broader historical inquiry. They step back from the ticker tape of 2026 and look at historical precedents.
Yeah, they are looking for other moments in history where fading empires suffered sudden, massive humiliations.
Here's where it gets really interesting. Because a stock portfolio can eventually recover from a 16% drawdown. Algorithms adjust.
Sure.
But geopolitical credibility isn't traded on an exchange. A nation's power doesn't just bounce back on a quarterly earnings call. Does the historical data show any precedent for a superpower recovering from this kind of structural, humiliating damage?
To answer that, the authors start with a massive historical parallel, the Suez Crisis of 1956.
This is a perfect case study. In 1956, Egyptian President Nasser nationalized the Suez Canal. Britain, France, and Israel secretly colluded to attack Egypt and take it back.
Right.
But they completely misjudged the global reaction. The United States, under Eisenhower, was furious and stepped in to stop it.
And the mechanism Eisenhower used to stop Britain was purely financial.
Oh, yeah.
He threatened to dump the U.S. government's reserves of the British pound sterling, which would have crashed the British economy overnight.
So Britain was forced into a total, humiliating military withdrawal.
Exactly. The authors argued that the Suez Crisis was the exact moment the British Empire effectively died.
Really?
Yeah, Britain went into that conflict masquerading as a global superpower, but the financial realities proved they were actually a vassal to American economic might.
And the parallels the report draws to the 2026 Iran defeat are just devastating.
The symmetry is honestly haunting. Both crises involved a fading global power launching a highly unpopular military adventure.
Both relied on Israel as a primary junior partner.
Right. Both completely failed to achieve their strategic objectives, and both resulted in the aggressor being forced to accept utterly humiliating terms on the world stage.
After 1956, nobody took British military hegemony seriously ever again. The era was over. But the authors also look at other historical archetypes. They explore what they call the dictator's gamble.
Right. They look at Argentina in 1982. General Leopoldo Galtieri was facing a massive domestic economic crisis and plummeting approval ratings.
So to distract the populace, he gambled everything by invading the British-held Falkland Islands.
Exactly. And he lost that war spectacularly. The mechanism of his defeat triggered the total collapse of the Argentine stock market and the eventual fall of his military junta.
Then the authors point to Russia in 2022. Vladimir Putin launched his invasion of Ukraine.
And the immediate result was catastrophic for Russian wealth. The Moscow exchange, the MOEX, crashed 33% in a single day.
And the mechanics of that crash were so severe that the Russian central bank had to forcibly close the market for nearly a month just to prevent total evaporation of capital.
Russia instantly became an uninvestable international pariah.
The authors even weave in the collapse of the Soviet Union in 1991 to solidify their point, don't they?
Yeah, they do. They argue that grand empires rarely fall because a foreign army marches into their capital. They fall because of internal rot.
Which means?
They collapse when their own leaders make increasingly catastrophic, ego-driven decisions like clinging to the rigid failures of central planning or bleeding out their military prestige in an unwinnable war in Afghanistan.
And stubbornly refusing to pivot when the data screams that they are failing.
Exactly.
This raises the ultimate question of the entire analysis. If the 2026 Iran defeat is America's Suez Crisis, does that mean the American era is officially over?
Well, the authors argue that the survival of a nation after a catastrophic, humiliating defeat depends entirely on one mechanism, its political immune system.
Speed of correction.
That is the core through line connecting all of their historical case studies. The nations that actually survive these massive geopolitical blunders are the ones that possess the institutional flexibility to correct course immediately.
Okay, let's look back at Suez. Within weeks of that historic humiliation, the British Prime Minister, Anthony Eden, was gone.
Right.
His own Conservative Party recognized the magnitude of the disaster, realized he had destroyed their credibility, and forced him to resign.
Argentina is another great example. The military junta didn't survive the year after the Falklands disaster. The shock of the defeat broke the authoritarian spell, paving the way for Argentina's return to democracy.
Even looking at a purely economic self-inflicted wound, like the Brexit vote in 2016. When the vote unexpectedly passed and the pound sterling crashed overnight, Prime Minister David Cameron resigned the very next morning.
Yeah. They all made a decisive institutional break from the architect of the failure.
But then you look at the counterexample, Russia.
Right.
Putin launched a disastrous war, the market crashed, his geopolitical leverage evaporated. But he stayed in power.
And the authors point out the mechanism of that stagnation. Because there was no political correction, The damage compounds daily.
The Russian market remains a shell of its former self because the fundamental source of the chaos is still sitting at the head of the table.
Exactly. And this raises an incredibly important question, and it is the chilling final thought the authors pose for America in the wake of 2026. Well, their data overwhelmingly shows that the strategic defeat in Iran is total. The economic damage from the tariffs and the surrender of the Strait of Hormuz is profound. But how quickly will the American body politic recognize the sheer magnitude of the disaster and activate its immune system to change course?
And more importantly, for the financial analysts writing this report, how do we know when that immune response actually begins?
The authors conclude that the stock market will be the first entity to signal the correction.
Because markets are forward-looking mechanisms.
Right. The moment institutional capital sniffs out that the chaotic elements of the administration are being neutralized, or that a return to geopolitical stability is imminent, the market will reprice that optimism. The S&P will recover before the history books are even written.
So what does this all mean for you, the person listening right now? We've talked about maximum drawdowns, implied volatility on the VIX, maritime insurance cascades, and the fall of the British Empire.
It's a lot.
It is. But these aren't just abstract concepts or numbers flickering on a Bloomberg terminal.
No, they are deeply tangible. They are the collective, unvarnished judgment of millions of people, algorithms, and institutions putting trillions of dollars on the line.
Exactly. They represent objective reality. The market doesn't care about political spin. It prices in competence, stability, and whether the people in charge of the global reserve currency are steering the ship safely or intentionally driving it into a hurricane.
Yeah. And according to the conservative authors of this data, the market's judgment on these massive self-inflicted wounds, the chaotic trade wars, and the historic military capitulation in Iran under the current administration is absolute.
If we connect this to the bigger picture, the true value of this analysis goes far beyond the immediate shock of 2026.
Definitely.
Whether or not you agree with the specific political leanings of the authors, their empirical data reveals a universal law of geopolitics. Global markets violently abhor self-inflicted chaos.
But crucially, they also reward decisive political renewal. History proves that a nation's lowest, most humiliating moment doesn't necessarily have to be its end, provided the society still has the capacity to hold failure accountable and self-correct.
We started today talking about how a nation's decline can feel like a slow leak until suddenly you hit a massive spike and experience a blowout. The wreckage is undeniable.
Yeah.
The authors forcefully argue that the stock market is the ultimate, nonpartisan judge of that history, capturing the exact terrifying moment the blowout occurs.
That's sobering.
It makes you wonder, if global markets price in the end of a geopolitical era this efficiently, and we can literally track the panic in real time, what other subtle global shifts, what other slow leaks in American dominance are currently hiding in your 401k, just waiting for the history books to finally catch up?